Hello and welcome to a PrivCap webinar. My name is David Snow. I'm founder and CEO of PrivCap. And today we've got a very exciting topic for you. It's all about the application of new technologies to hard assets, infrastructure, and other kinds of assets that are very attractive and increasingly attractive to institutional investors. And yet, on top of that, we have all these new technologies such as artificial intelligence and data science and even drones that are being applied to these assets and sort of changing the investment outlook for them in exciting ways. Before we begin, I'd like to ask our three experts to briefly introduce themselves. And let's start with Brandon from KKR.
Hi, good morning. Thanks, David. Great to be with you all. Just my background, I'm a partner at KKR and lead our North American infrastructure team. I've been with the firm for about 12 years, from joining on the private equity side. This is before we really had an infrastructure platform and have been part of the infrastructure business we've been building really since inception. So great to be with you all.
Great. And now Dana Sands from Energy Infrastructure Partners.
Hi, I'm Dana Sands from Energy Infrastructure Partners. We're a small investment bank that focuses on energy and infrastructure. What do you know? I come to this from not only the investment banking perspective, but also the investing perspective and this perspective of a CFO. So I was with Alinda Capital, one of the first employees when we raised $3 billion and invested it and raised a second fund of $4 billion and invested that as well. But I also have direct experience on the side of the CFO working at a renewable energy company for about 4 years. And I started at Morgan Stanley in investment banking and now in investment banking again.
Yeah, hi, this is Tim Buckner. I'm the co-founder and COO of Mercatus. We're a 10-year-old software company kind of born as out of being an investment bank and growing into a software company to really solve our own challenges. We started our company 10 years ago, and over the last 10 years have really grown from supporting organizations like funds and large asset managers from, about all the renewable asset classes all the way through to large infrastructure. And so today we have about $450 billion that are managed on our platform across 110 countries.
Great. Well, let me just make some brief opening comments about this webinar. It is designed to be interactive. You, the audience, will have the opportunity to send questions in, and we'll certainly try to get to all the best questions that we can. Typically, we will address the questions in the final 10 to 15 minutes of the webinar, but if something comes in that's especially relevant, we might pause to answer it. So why don't we start with a question for Brandon. Brandon, you've been investing in all kinds of infrastructure and hard assets for a while. As you think across the many different forms of technology, whether, again, it's data science, artificial intelligence, machine learning, even drones, talk about the impact that these new technologies will have on the investment opportunity across infrastructure.
Sure. Yeah. Look, as we were thinking about the impact of technology on all these various sectors a number of years ago, all the partners at the firm got together and we realized that we have a lot of technology content and depth at the firm, but it all really sat within our technology private equity group. And of course, the reality is that all these technology trends cut across everything we do as a firm, whether it's in industrials or consumer products, and of course, infrastructure. And of course, within infrastructure, if you look at the three largest sectors that we tend to focus on within KKR, there's a wide range of sectors, but the ones that yield the most reliable and recurring deal flow are midstream, power and utilities, and communications infrastructure. And each one of those is really susceptible to disruption, from these technologies. Whether it's on the midstream side, clearly the shift towards renewables could have long-term implications on demand for hydrocarbons. On the power and utility side, clearly the battery technology, but also demand-side management, both could have pretty dramatic long-term implications on the whole architecture of the grid. And of course, on the communication side, in many ways, that's really at the tip of the spear. And as you look at the rollout of 5G and its successor, that could have dramatic implications on, various different parts of the value chain, whether it's data centers or towers and so on. And as we reflected on, there's probably only, the only sector I can really think about within infrastructure that feels pretty immune from disruption is water utilities. We don't have any better ideas than pipes leading into residential homes delivering water for how that ought to evolve. So that seems pretty safe. But it seems like all these sectors are very susceptible to disruption, and having all of our sort of technology content and depth reside in our technology private equity team didn't make a lot of sense. We really created this innovation team that really cuts across the entire firm a number of years ago to really help all of our investment teams think about how to get ahead of these disruptive trends. And to really think, probabilistically about them, because I think when you look at all these trends, again, maybe putting water utilities aside, you can sort of talk yourself out of doing anything because everything is, to some degree, susceptible to disruption. But I think, having this team that's able to help us, take a fresh look at all of these trends and form a view around timing and probability has allowed us to be a bit more thoughtful around which trends we lean into, which ones give us real pause today, and we could talk obviously about specific examples around that, around the various sectors we talked about.
Great. Maybe next question for Tim. As someone who oversees a platform with just a ton of information about real assets, how are you seeing asset owners and asset managers increasingly use data as they try to add value to these assets?
Yeah, thanks for the question. So, as a starting point, since we started the company, just looking across infra, we've seen roughly $8 trillion go into the space. And as that's grown, we've really grown from supporting a single asset class to over 12 today. And we've just seen tremendous variance in how investors and operators really look across energy and infra and how they manage and utilize data across, we'll call it from decisions to strategies, investments, and just even in their everyday workflows. And for, some of the better run companies, we've just seen a huge influx of, the investments that they're making and sort of even the corresponding applications utilizing data intelligence and science. And so, when I think about examples that have been sort of most exciting and sort of groundbreaking, maybe as a starting point, just what's become table stakes and almost boring, which is exciting to even hear, is that even in just power generation alone, operators are really driving now close to real-time data feeds to all their assets and it's all about maximizing performance, and minimizing OpEx. And I think primarily that's been driven just because, more and more requirements have been, around hitting returns and maximizing returns. And it's been all about, reducing margin compression that has really driven for how do I make sure that operational assets are, more and more optimized. And what's interesting about that is that I call that baseline. But what's exciting and the innovations we've seen is how sort of that technical data has been merged with financial data, and then the two kind of coming together in perfect storms where there's this emergence of dynamic pricing that's happening in infra. So like if you just use electric vehicles as an example, where sort of some of the companies that work within our platform, they're the leading companies which sort of are looking for real-time adjustments to charges and looking at that in sort of a variety of different reasons, right? So they're looking at it from sort of how customers are, when customers are willing to pay, the value they place on that service balanced against the urgency of that usage. And so what's interesting is that, technology has to meet sort of, we'll call it the operational characteristics of these assets. And it's not so easy in a lot of these organizations.
Maybe a question back for you, Brandon. Can you give a specific example of an investment that you've made where a specific form of technology has sort of made an exciting operational difference, or you expect it to make an exciting operational difference?
Sure. Yeah, I'm happy to give one or two, and maybe to step back a little bit. I know we're talking here about AI and machine learning and and so on. I think there are some fairly narrow areas where we've been able to leverage that in infrastructure, to some extent more on the operational side. I'd say broadly within the firm, we certainly see more of that in areas like consumer products, where you can use machine learning to sort of spot trends before the before the sales data validates it. But within infrastructure, I think what we found is that the real opportunity is that you look at a lot of these industrial businesses, and in many ways they're really built on a 1980s and 1990s software architecture. And
that's right.
And we see this really, it cuts across every sector we look at. And so in the same way that we have our technology specialists, 5 years ago, we're all sitting in our technology team and we tried to create this capability at the firm level. If you look at where, just broadly within the economy, where the top engineers and technologists go, they're going to technology companies. They're not going to parking businesses and to waste management businesses and so on. And so I think what we found is that, leveraging through our operational team at Capstone, which is our operational improvement team, and outside parties, we're able to go and, while we're not deploying AI and machine learning to sort of get all these reams of data and, plug it into a machine and, spit out an answer, we found that we're able to deploy 21st century technology, software, and architecture to drive pretty dramatic performance improvements. So just to pick an example, we own a parking business in Europe. We could talk about the long-term disruption trends that business could be susceptible to and how we got comfortable with that. But if you think about what a parking business does, it manages an inventory of parking spaces. And the historical approach to that is you set a price and you get what you get from a revenue perspective. And that's really been the sort of the 1980s and 1990s architecture of pricing and revenue management that most parking businesses deploy, particularly since they're all pretty fragmented and at small scale. And if you can deploy a revenue management system that really looks at your historical data, understands the trends and time of day and areas for revenue optimization, you can introduce, whether it's time of day pricing or other features, to really optimize pricing and revenue without any real capital deployment. And so that's not a machine learning or an AI type of functionality, and maybe those tools in the future will lead to something that dramatically changes the game again. But we found that just running a playbook of just leveraging the best 21st century technology out there can really lead to pretty interesting operational improvement opportunities.
Can you guys hear me now?
Yes, Dana,
David?
you sound great.
Okay, I'm back.
Okay,
great. I just wanted to, jump in there on parking as well. I mean, I just think that's one of the great P3 opportunities for investors. There's so much that can be done to maximize revenue and to minimize costs. Almost every part of the parking chain can be automized, whether it's parking enforcement. Now a van can just drive down the street and sort of issue tickets automatically, to parking collection. It's all done by the data-driven right now to optimizing, again, the revenue. I mean, I worked on one really, really large parking transaction where the city refused to let the investors do dynamic pricing or lower the prices. There was a minimum price that we always had to charge. And the city didn't realize anything about elasticity of demand and how to maximize revenue. I think that people have learned a lot since that transaction got done. But both in the on-street and off-street parking, it's about sensors, it's about wireless communication, it's about, for off-street parking, it's about increasing the number of cars that can be put into the same amount of space. If you can completely automate garage parking, you can fit 3 to 4 times the number of cars than you otherwise would. And it's much faster than going to get your car. There's a garage in Boulder, Colorado that is completely automated. It's got a parking robot. They guarantee delivery of your car in 3 to 4 minutes without any human interaction at all. They use lasers and sensors. It's just a very, very interesting area. And I also just wanted to make one comment about water. Even the utilities do have access to more interesting water services companies that can better detect leaks. There's all kinds of technology improvements there. And we see across the broader definition of water, wastewater, smart wastewater facilities are now using anaerobic digestion to power their own facilities. So in Hartford, Connecticut, they're completely off the grid with a really innovative anaerobic digestion that takes the wastewater, gas created from wastewater and turns it into electricity that runs the plant. And, when I was at Linda, we worked on the first water recycling facility in the country that was owned by a municipality. So I think there's just a lot of opportunities of water and desalinization, and the more water's used in fracking, the more near and dear it is. So I'm really very bullish on different water technologies.
Yeah, and
this is Tim.
Sorry, I was just going to say that while I sort of minimize the role of machine learning and big data day to day, I think one of the areas within infrastructure where we definitely have seen that be relevant is when you think about pipelines, whether it's on the water side or on the energy side, so oil or gas. You've really got thousands of miles of flows and data collection at various intervals along those lines. And one of the areas where we have seen machine learning be quite relevant is really around leak detection and really predicting when those leaks or when you're going to have operational issues. And I think just given the amount of data to be able to mine that data and forecast when you're going to have an issue and go get at it before it happens, I think that has been one application we've seen that's actually pretty significant when you think about just the overall operational risk, safety risk, and efficiency of these kinds of assets.
So this is Tim. So I kind of have a question and a response kind of packed into one for both of you guys, because I think that as we've been talking about parking and we've been talking about sort of different energy type assets, one thing from an investor perspective, given we've got a lot of GPs on the phone and we've got a lot of private equity investors on the phone, I'm interested in just the evolution of sort of asset level investing and sort of the growing need of, as you have complexity and you have diversity of all these assets that are out there, parking being a great example, like how much are you treating every investment as sort of its own P&L? And when you are treating it as its own P&L and you talk about data management, Brendan, like how are you seeing that evolve within KKR, within partnership companies? I've got a response too, but I'm just interested in your view.
Yeah, I mean, look, the way we came at infrastructure is really from our private equity mindset. Having been in the private equity business since the 70s, and so our approach is really to take our private equity toolkit and deploy that in companies that own infrastructure assets. And so we haven't. If you look at our investment track record, it's been less about buying a toll road here and an individual asset there, and more around acquiring, building, or partnering with companies to go build businesses in infrastructure sectors. The predominant ones being power and utilities, midstream, and communications, but it cuts across a number of other sectors. And so the way for us that really starts and ends with partnering with the best management teams and the best companies in those areas. But then, we really leverage, what we've done in private equity for a long time, which is to supplement that with our internal operational capability, which we've since, sort of broadened to really cover this or encompass this innovation area to help our companies get ahead of some of these trends. And so, if we own a communications company, working with them to think about, what does the deployment of 5G mean for the various different, parts of the value chain within communications? How should we think about the risk that poses to data centers versus fiber versus towers? And you can come up with analogous examples across all the other industries we cover.
Yeah, I think that with when the difficulty of achieving the returns that investors are trying to in infrastructure and the proclivity of low returns in infrastructure, you really can't invest in an infrastructure asset that you don't think can improve the return. So if the firm were just going to invest in an asset that sits there that you cannot improve the returns, it's not an investment any of today's infrastructure investors would make. At Alinda, it was all about, we had more people dealing with improving the returns on the assets and then going to find new assets to invest in.
Yeah, I mean, just to bridge the two discussions, because I think it's actually a really interesting discussion, sort of private equity on one side, who invest with portfolio companies, and sort of asset level investors or even portfolio level investors on the other. A growing trend that we see is that private equity firms are trying to help support digital strategies, and that could be machine learning, or even just helping portfolio companies just get the basics of centralizing that data across all of the different disparate asset classes to be able to do the level of analysis they should be doing at sort of the portfolio level company, and even organizations that are moving to sort of out of private equity and moving into much more direct investing. What we're finding is that as they're making their first infrastructure, they're raising their first infrastructure fund, maybe they're on their third or fourth, they're looking at those assets of how do I optimize those, and gosh, the level of complexity, because there's a lot of diversity now. Maybe they're doing toll roads on one side, they're doing bridges on another, and then they're doing energy and infra energy specifically on another. It creates a world of complexity that I think organizations are now hitting a level of we'll call it complexity curve and level that they have to do something about it. So what we're finding at least is that organizations definitely are trying to look at optimizing, but also making sure that they're actually hitting the returns that they're saying, both at the asset level and the company level. So we're seeing a huge trend there.
I do have a question for all of you regarding due diligence, but before we go there, Dana, you did mention in our planning call having a really interesting insight about bridges as assets and the use of drones. Can you tell us about that? Because it sounds very futuristic.
Yeah, it's faster, it's cheaper, and it's safer. So to inspect bridges, very few humans are now climbing up on the rigging. It's all done by drones, and it's much cheaper and safer. And the other thing I think that really changed bridges is the transponders. And again, it's sort of like parking and real-time revenue generation. I know one bridge owner that sends out emails for discounts over the weekend because they want to get the traffic up over weekends, because a lot of the traffic on this particular bridge is work-related. And it's been able to increase their revenue by 5 to 10% just by using real-time pricing and something as simple as email. But drones can be used in many different types of inspections and many different assets. But bridges in particular, since they're so high and dangerous, it saved lives, this person says, this investor says.
I also know that, I don't know if any of you invest in energy infrastructure, but I do know that drones are being increasingly used, I believe, in pipelines and in oil fields. It's just an easier way to get to some of these assets that are in far-flung locations.
Mm-hmm.
Great. Well, here's a question for all three of you, which is, there's optimizing the asset using new technologies, but then there's vetting and performing due diligence while you're trying to or thinking about underwriting the asset. And I'm wondering what you think there are by way of advances in technology that or data science that allows you to understand the assets that you may invest in during the due diligence phase. Maybe throwing the first question over to Brandon.
Yeah, no, look, I think like I said, we don't yet have a sort of a supercomputer where we just feed in a bunch of data from social media and other sort of crawling the web and sort of that culminates with it spitting out an answer around what's going to happen. We may get there, but we're certainly not there yet. But what we do is really pull in other folks at KKR who have a point of view and who can help us understand the key question that frames up the disruption risk. So, for instance, I can give you a couple of examples. We looked at, a waste management company a couple of years ago that had both, landfills, but also a collections business. And I think as we looked at the nature of the collections business, which talking about 1980s and 1990s architecture, if you just look at sort of the route management and the sort of the dispatch profile of how these collections, these waste collections businesses are run, they haven't changed much over a long time, and yet there's so much data there to be mined around how to optimize that route management. And now, and now the ability to actually have sort of a feedback loop so that the customer can actually, sort of buy waste collection on demand, and it almost sort of is the Uberification of the collections business, and that could be, quite disruptive. If you think about a business that, where the legacy is that you make a stop along the route, every day or every 2 days or along, whatever the typical schedule is, to something that's more on demand. And I think having the capability to understand as best as we can how those trends could impact these businesses is game changing. But I think I go back to the prior point, which is you can sort of talk yourself out of any of these sectors when you look at the the risk over the next 10, 20, 30 years. And the reality is that if you look at where multiples are today, if you're paying a multiple well above 10 times, you do have to have a point of view around what the world's going to look like 10, 15, 20 years from now. Because you're paying for cash flows out well into the future. And I think what we've tried to do is really think probabilistically around all these trends, frame out which ones seem more likely and which ones seem more distant, not just timing wise but probability wise. And it's okay to for the answer to some of these questions to be I don't know. You just then need to reflect that in your thinking around the range of outcomes and what you want to, how much risk you want to take on around that.
I can name the 3 different areas where technology has helped improve the due diligence process. And just, really briefly, in wind, data from met towers. In solar, stuff like the insolation statistics, PV assist is something as simple as that. And traffic studies, where you can have a much more comprehensive traffic study because people aren't out there counting cars anymore. They're using sensors. Anything that makes any technology that decreases risks for investors is just it's great for the industry.
Yeah. Yeah, this is Tim. I mean, maybe one additional part, because I don't want to add to what other people have said, other than say that, if I think of internal to organizations, like organizations, that are, even customers of ours and companies that we've seen actually have best practices around how to drive repeatable due diligence, is that I think a lot of the industry, there's one hidden problem with our industry, is that most of it's run out of Excel. And as a result of most of it being run out of Excel, very few organizations actually think of, well, how do I, extract the very best value out of Excel, and leverage it as the best engine in the world to model all these, kind of risks and returns. But also, how do I extract every change that ever has been happening, so I can actually use that learning as a way to actually say, well, what did I say in my investment thesis, committee number 1, and what did I actually underwrite to, and what did I actually see in operation 2 to 3 years later or 20 years later? And if I think of due diligence kind of innovations, some of our largest customers have actually created real strong investment processes across their life cycle, where they've actually thought about the engine from start to finish and used the power of Excel, but then also used the power of extracting from Excel into an actual database to really leverage that data to then actually compare to front to back. And I think that in order for us to have the innovations around continuing to save every last basis point you possibly can in this market, we've seen as much as 300 basis points lost from that start to finish, beginning to end. And as a result of that, that's a whole lot of profit to gain back. And so I think in due diligence, to actually think about how data is managed in and out of Excel is a real important innovation for the people on the call, for sure.
Well, I'd like to get some questions from the audience. We do have a few good ones that I think we should address, but maybe just one more quick topic, because it's so interesting, and maybe we could start with Dana. There are investable water assets out there that are being profoundly affected by some of these technologies. Can you talk about a few of those investment opportunities?
Yeah, I think I've mentioned briefly, one of the areas that I think is really, really interesting is wastewater. The fact that there's such a dearth of water in so many different areas, people are getting smarter and smarter on how to deal with it. Whether it's produced water from fracking, whether it's water that's salty in western Texas that needs to be desalinized, whether it's creating energy from your wastewater treatment plant and anaerobic digestion. They're all opportunities that I think are really front and center for infrastructure investors. I mean, there's other areas of water that are a little bit farther out there. I was looking at a company the other day that actually uses salt water to irrigate plants and trees. It's because the tubes that they use transport only the water vapor, not the solutes, not the saline, and they're using it to water citrus groves in Florida with salt water. I mean, I think hydropower, it's crazy. These things also are on the cutting edge, but there's actually testing a vehicle to use hydro-powered vehicles, to use water to power the engine. I just think there's so many different mobile recycling facilities for water to be used out in the Bakken or whatever. It's really, really, really endless, and I think it's almost more wastewater opportunities and desalination opportunities than water itself.
Well, why don't we go to a question from the audience? We've got about 15 minutes left, and we'd love to get some good questions in. There's a question about recessions and, I guess, cyclicality of infrastructure assets. Can you talk about the impact, whether technology makes some of these assets more prone to recessions or less prone to recessions, and what do you think might move the needle? Maybe, I guess, starting with Brandon.
Sure. Yeah. I mean, look, I think most of the sectors we focus on do have some susceptibility to the economic cycle. Certainly anything along the energy value chain, to the extent it has any volume risk, is susceptible to that. So that'd be midstream, and power as well, if you're susceptible to demand. I think on the communication side, there's clear susceptibility there, particularly if you're serving enterprise customers. And so, look, I don't think technology has all the answers around these questions. It certainly doesn't make the business models more immune to the economic cycle. But I think it probably does help to some extent. Again, I think this is more deploying sort of 21st century technology versus the bleeding edge of AI and machine learning, at least today. But I think it can help us understand, the implications of where we are in the economic cycle a little bit better. It's amazing when you think about all the sophisticated tools that we have, and yet, in many times when we're talking about these questions around the economic cycle, we're very crudely comparing back to, well, what did it look like during the financial crisis, to frame out, what does the worst case look like, and what did recessions earlier in the 2000s look like. And I think having having more data and the ability to parse that out allows us to be a bit more informed around what does the next cycle likely look like.
Yeah, I mean, personally, I really like, Brandon, your analysis just at the end there, because I think that, so many of the companies we work with are trying to have to, look far out and really run sensitivities and forecast challenges, and whether it's market fluctuations, whether it happens to be recessions, et cetera. I mean, that part of the job of the CEO and CFO of these organizations is to ensure that they're constantly looking and doing what ifs. And, if I think of like the bigger challenge that we've found, and you think about sort of what happens when, probably not if, when, we do get hit with a recession, what will organizations have to do? Well, they can no longer proportionally add the same level of headcount that they used to sort of proportionally do all the things that they're doing today and all the cool whiz bang stuff we've been talking about today. And so everybody's going to look at tightening their belt. And so, some organizations will say, well, gosh, I got ahead of that curve and looked to automation, look to centralization, look to be data-led, and other organizations, are going to be caught, with their, with their hands, not ready to do anything. So I think one of the nice things about the discussion, or even question, is just to make sure that organizations on this call really are thinking about, what ifing their business and how are they getting prepared for it.
I think that one of the real policies of infrastructure funds in the beginning, when the first infrastructure funds were raised, was all about we are recession-proof or nearly recession-proof. That's many infrastructure funds were were raised as a hedge against recession, but we've been through the cycle, and it's absolutely not true. Almost no asset is recession-proof.
Mm-hmm. We have a question here about electric mobility projects. I guess this refers to charging stations for electric vehicles. How is that type of asset shaping up as an investable opportunity? Has anyone here been involved in an investment of that sort?
Sure. This is Brandon. I'm happy to jump in. And we have actually part of our team based in our office in Menlo Park, California, which is in the hub of Silicon Valley, and so we feel like we're able to keep stay pretty close to some of these trends around new technologies, and we've definitely, if you think about charging stations and the electrification of the fleet, that's going to be a huge source of there's going to be a need for a lot of capital to deploy those facilities really across the whole landscape in the U.S. The challenge, I think there's really two challenges there around charging stations that make it not actionable at scale today for us. I think it's probably actionable at a smaller scale, but it's certainly something we think we're going to be spending more time on 3-4 years out. I think the two challenges are, one, that the technology is getting up the curve. This is now more about evolution rather than revolution. But I think once you can get to the point where someone can charge their vehicle when they're outside the house and not at home, and it takes 15-20 minutes instead of an hour. I think that's when you're gonna see the adoption increase significantly. I think the other question that's just very much up in the air, and this is not so much a technology question as it is a commercial question, is just what the revenue model is going to be around these facilities. I think there's a full range of commercial models we've seen, going from sort of advertiser based to the commercial location, whether it's a Whole Foods or otherwise, pays for the facility, and they have a couple of parking spaces in front of the store, and you get to use it if you're there on a first come first serve, and it's quote unquote free, to subscription based models. And so I think the maturation of the industry, which will start with the improvement in the technology, which I think is inevitable, will, I think, lead to a bottoming out of which of these revenue models will really last. And I think once you have that, then you start to have the ingredients for infrastructure capital coming in, pricing out the revenue model with contracts or with a view on demand, and for infrastructure capital like ours to be part of the solution there.
Yeah, maybe just one comment from Tim, on just building on what you just described, is I think, so we have several companies that are actually building out pretty substantial EV fleets that coming out of actually being pretty large power producers and we'll call it other infrastructure investors. And I would say I would equate exactly what you just described, as each of these companies are treating each of these EV stations as an asset, as its own investment on its own right. And I think if there's one major trend we've seen is that we don't really know what those business models are. And so as a result, these organizations are having to be very flexible in, number one, how data is coming into their solutions and how they are able to actually turn on a dime. For some markets, it's one business model, other markets, it's another. And so how they think about deploying technology and actually reading in information from those EV stations has become paramount. And we have one great example of a very fast-moving customer that's based in Italy, and they're building out one of the largest networks across Italy and across Europe. And as they're doing that, if there's one thing they've said to us many times over is, the flexibility of our business model is paramount, as we continue to grow.
Great. Well, we have a question here about public-private partnerships, PPPs. Maybe we can throw that one to Dana. Dana, are there any particular PPP opportunities that you think the application of some of these new technologies sort of enhances or makes more viable?
I think they make them all more viable. They make them
right.
Certainly, parking is I think a win-win situation for cities, and there have been several successful P3s done in the parking area. I think tolled express lanes can also be done quite easily. I think every P3 is a challenge, but if you have technology that's going to help the profitability. That's one area where investors can come in and spend the money to upgrade, upgrade the pipes, upgrade the technology equipment to get more money out of the existing assets. Almost any infrastructure asset class that can be done. I think the difficulty with P3s is getting them approved. When we were at Alinda, we won the Alligator Alley P3. We were awarded it, and then the next day the governor took it away. It's just, they're very challenging to do.
Yeah, this is Brandon. I would just jump in there. We've done a couple of municipal water P3s in the Northeast. I believe it's still 2 of the 3 that have ever been done in the U.S. on the municipal water side. And I definitely agree with Dana's comment. That the answer to more P3s is definitely not going to lie in technology. There's a ton of capital on the sidelines that would love to participate in P3s, and so there's a supply of capital. There's a tremendous demand for capital in the sense that you have a lot of aging infrastructure, whether it's water or elsewhere. So I think everything points to the notion that there ought to be a lot more P3s. I think it's just the day-to-day inner workings of various layers of government that make them so challenging that a lot of people just say life's too short.
It's too hard, yeah. And we did one of the other ones. We did Santa Paula, California, which was a wastewater P3. We think it was the first one ever done in the country, and it definitely was fraught with difficulties. But I think wastewater is better than water. I don't think municipalities want to give their water assets away because they're afraid of terrorists. Honestly, that's what we hear every time. Somebody could poison the wells, so to speak.
It sounds like technology is not going to solve political problems, at least in the near future.
No.
Well, we have about 1 minute left. Maybe we could kind of do a speed round here, and I'll ask all 3 of you, and I know it's a big question and I need a short answer, but I'll ask all 3 of you, what you think are going to be some of the major trends in infrastructure investing, over the next year. What are you excited about, or what are you worried about? Maybe we can start with Brandon.
Sure. I mean, I think macro-wise, you just look at everything we're seeing in terms of mobile applications and the usage of data, and that that just seems to bode very well for continued growth in communications infrastructure, and it seems like there's a lot of runway ahead of that, and so feels in many ways like we're in the early innings of that. Now valuations are high, and there will be disruption in some of those business models, but I think some parts of the value chain, like fiber, for instance, seem in towers, probably more durable and immune from some of that change. And the concern is really just, to some of the prior comments, multiples are high, and I think having high multiples in the context of businesses that are in some cases susceptible to disruption, it warrants caution, and it warrants an approach where you really do think probabilistically around some of these risks, and that requires a discerning approach in this environment.
Dana, what are you excited about for 2019?
I was thinking about that as far as new funds are concerned, and I've met with several prospective asset managers that are trying to raise smaller funds. I think there's too much competition among the big funds on a very limited number of good assets, and I think that some of the returns are going to be targeted to be a little bit lower, and I believe that the definition of infrastructure is going to be broadened so that the investors can become more creative in what they do and try to get a little bit higher return.
And Tim, as someone with many, many clients who invest in hard assets, what are you looking at in 2019?
Yeah, I mean, well, as a starting point, I mean, as you look at sort of research, roughly about 90% of all data in infrastructure and energy has been sort of even created over the last 5 years. And, to me, what really gets exciting is when you really think about the amount of investment that we've averaged roughly in infrastructure, roughly $2 trillion a year. It's expected to double. And, by 2030, we're talking about roughly $80 trillion of investments being done from now till then. And if you really just think about, we're going to be 8Xing kind of where the $10 trillion we were 2 years ago to 8Xing that, or even if it's 6Xing it, that just means that's that many more investors, that many more complexities, but more importantly, that many more assets and portfolio companies out there. And so that means the huge need to do a lot with data. And to me, that's what gets really exciting. And, Brendan, you used a baseball analogy and said you're in the early innings. I'd say we're in the pregame where a lot of companies are they really need to get prepared, for this onslaught of data and this opportunity that's coming. And, as I've been traveling a ton in the market, seeing, PE companies and real estate firms now coming into infra, there's just a lot of opportunity now, and seeing a lot of great opportunity for these organizations to do a lot with the data to come.
Well, it sounds like based on the growth of the asset class, we're going to be doing a lot more talking about what's going on with hard assets and infrastructure. And I hope that when we do, I can turn to the three of you as experts to present to our audience. For now, we're going to have to wrap up, but thank you very much to the three of you for sharing your expertise. Thanks to Mercatus for being our partner on this webinar, and thank you to the audience for listening in. This webinar will be available in playback mode. It will be available as a podcast on iTunes, and we will be turning it into a report available via privcap.com. Thank you very much, and have a nice day.
Thank you.
Thanks so much.
Bye-bye.
Thank you.
Bye.